There's still debate about whether Jay Powell blinked yesterday and changed the strategy of the Fed. Maybe they have only raised rates 2 more times. For you, is that something of a green light to put more money to work in the equity market at this point, or not?
It is, and you know, there's so much you can look into and try to read his comments and really slice and dice them. But really, the thing that I picked up, 4 words: no preset policy path. And that tells you he's not going to be hard-headed. He's going to look at the data. And as an equity manager that's looking for disconnects, like we do here at the Hodges funds, you know, that's what I want. That's what I wanted to hear. He's going to. It'll ebb and flow, and as the economy grows, he'll be a little more aggressive. And as we're seeing all these weak signs out there, homes, home building, energy, you know, industrials, and I'm sure he sees that, and that's why he's backing off. So yes, that's what I wanted to see, and those 4 words made me all clear. And
Eric, what about you? Not only Fed, we get the meeting minutes for the most recent meeting coming up in an hour or so. You also have the trade deal possibilities with China. If they don't put the 25% tariffs on, there's talk that maybe that can spark another rally in the market. I mean, what are you watching here to tell you what to put more money to work?
Yeah, right. Well, those are the 2 big narratives that people are watching. And we're calling yesterday the Jay Powell is not loco 600-point rally. So we had that yesterday. And now I think we're moving on to the next topic, which is the trade deal or the relationships with China. And again, we're feeling, you know, sort of cautiously optimistic that there's not going to be anything terrible out of that. So we also are feeling pretty bullish, you know, going into the Santa Claus rally time of the year.
Craig, Jackie was just on talking about the price of crude oil. It's up 3% right now during the session, but still hovering near that psychological $50 a barrel. Is that something we should be thinking about when we're computing economic global growth? We need to worry about that, do we not?
Yeah, I think that's somewhat of, you know, the demand part of it. But that ebbs and flows, and we do, you know, obviously the reason it's come from 80 to this level is because of oversupply. But there are, you know, although, you know, we make about 3,000 company touches over 1,000 different companies here at the Hodges funds, we're not picking up on any sort of economic weakness, but the stocks are. And so you have to look into that, and you have to say somewhat that a lot of that's been discounted. That's why we're bullish, because a lot of these things, home builders have been cut in half, and, you know, energy stocks have just gotten clobbered. And there's a lot of areas that's already factored in the negative news. So I think from that standpoint, it's a good area to be, you know, picking up stuff that great companies that have gone on sale.
What's the catalyst for the home builders, Craig? I'm just curious. I mean, it's supposedly we were in an environment in which the consumer was very strong, spending is very strong, mortgage rates have been low, mortgage rates are going to go higher. You know, there's some doubts about the economy going forward. Why does the backdrop for home builders get better? Just because they're cheap right now?
Well, but I think it's more, you know, and we talked to a lot of home builders. We probably had conversations just this week with 3 of them. And they're not seeing a big slowdown. They are seeing sticker shock. It's like us. Anytime you see something that's 20% higher than you, it takes a little while to make that, you know, to absorb that into your brain. But rates are still low. If you can get a 4.8% mortgage or a 5% mortgage, that's still very cheap money. So I think, you know, we're not oversupplied on housing. The fact that most of them have been cut in half, I think it's a good long-term entry point. Would I do a whole portfolio of housing stocks? No. But at some of these prices, they make sense.
Eric, before we go, you're looking still at dividend stocks, even with rates going up here. And you got one example that we can talk about quickly, Douglas Dynamics.
Sure.
You go for it just for the dividend, or what do you like about it?
No, we think it's a terrific company. It's been growing. They make snowplow attachments and ice spreader attachments. So, of course, it's always a great seasonal stock here in Chicago as well. And the stock is cheap. I think, to Craig's point, a lot of companies have gotten very inexpensive recently. They had a somewhat challenging quarter, and the stock dropped 20%. That was an overreaction. So we think that this is a great opportunity to buy a really high-quality company at a discount price.